Yeah, it looks like we have a few more people. I'm Mark McKay. Welcome. We have a few more people logging in, so we'll give it just a minute, but we will keep this well under an hour, typically about 40 minutes. If you have any questions during the presentation, please feel free to put them in the chat room or reach out to us afterwards. We also will be setting appointments for a discovery call after the meeting. If you'd like to see if this is a fit for you or like to see a design specifically for your situation, just reach out to us. We typically follow up with a 15-minute phone call or Zoom call or FaceTime, whatever is easiest for you or you prefer. And we will, then to get a little bit of information, see if it's worth pursuing, and then actually put together a case study for you and set up a Zoom call typically with the experts. So it looks like we've got a pretty good crowd here. Let's go ahead and get started. So protect your assets and retire tax-free. What are we talking about here? Today, we're going to talk about why taxes are probably the biggest threat to your retirement. And I don't know if you've thought about it, but we are in a historically low tax environment. Rates are historically low. The current tax cuts have been extended through 2029, but somebody's going to have to pay the piper at some point. We're also going to talk about why there are some tax-free options to provide for retirement income, but we're going to talk about just briefly why your broker hasn't mentioned these to you yet. But we're not going to only talk about the problems. We're going to talk about some of the solutions, some of the alternatives to the traditional deferred taxes, 60-40 blend. It's not a crash, it's a correction, that type of an investment that has created the retirement crisis in this country. But we're going to show you some solutions using what we call tier one arbitrage to provide you with a predictable, secure, tax-free income throughout your retirement. And so it's one thing to pitch tax-free income, tax-free investment, set up options for your retirement. But if you just go and take everything out and put it in a muni bond fund or a municipal bond, you're going to get 0.75%. We need something to generate solid, tax-free, double-digit returns. And we're going to show you how to do this without the market risk and volatility of stocks, bonds, real estate. If you're a real estate investor in Texas, give me a call. We can show you how to set up this structure for a cash managed account that will supercharge the returns on your real estate investments, especially when there's so much unpredictability today and things can move so quickly. Maybe lumber prices have affected your long-term plan. We can show you how to not let that money just sit there in the bank in the meantime. All right, let's get started. So who is Mark McKay? I got my education at the University of Texas. I have a BBA from the McCombs School of Business. After University of Texas, we moved back. I worked for a wirehouse in Austin for a while and then moved back to Amarillo to start the investment department for the largest privately owned bank in the country. A little while later, my partner and wife, Marcy McKay, and I started what became the #1 financial talk show local in the Texas Panhandle. And we hosted that show for over 12 years on KGNC AM in Amarillo. Marcy and I have been married for over 30 years, coming up on 31, and I am the father to two 20-something kids. If you want to talk about a great investment, the kid with all the hair is on a free ride and a full ride and doesn't have to worry about brain injury. He's actually working on a fellowship from the Parkinson Foundation this summer. The beautiful blonde there is my daughter Mason. She's getting ready to go to PA school. So they're the reasons that I want to protect my assets, and I want to make sure that my retirement looks the way I want it to be. So What is the biggest threat to your retirement? I know I've already tipped my hand on this one, but in my slides, I'm not sure they did a great job of showing different types of threats, but I liked both of these pictures. The one on the left, actually, where we live out on the rim of Paladera Canyon, and I think it was in March or April, we had a tornado basically hop over us, touched down just south of here, and actually flipped some campers up on the. We're about a mile from the entrance to the state park, but it fortunately, thank God, missed us, and no one was hurt. It did flip some campers, but everybody had taken shelter. So, but I digress. So what is the biggest threat to your retirement? I don't know if anybody's seen this. I think it's usdebt.org or debt clock, but this is an actual running. This is actually a picture of that website. This isn't live, but this is from last week or so. But this is why you need to be concerned. This is why the traditional school of thinking, where defer taxes, defer taxes, defer taxes. When I got into this business, they used to give us little calculators. You know, I'm sure it was written basic code back then, but to show the magnificent power of, you know, we might have even been able to use 3-color printing back then, but to show the power of triple compounding. And so what are they talking about? Well, the big wirehouses that had to get bailed out in 2008, or 2001, or went away in 2001, they have always preached, you know, max out your tax deferred accounts, defer, defer, defer. And that way the money you would take to the IRS, send to the IRS, can grow. And then when you pull it out, the math very rarely works for that plan. Taxes are going to be higher during your retirement. Look at the debt, look at the deficit. We have a $3.5 trillion budget deficit. And I realize that includes a lot of the stimulus and pulling us out of the pandemic slowdown. But we were at $1 trillion deficit before that. I remember when the debt hit $1 trillion and people were freaking out. The debt is now $28.5 trillion. This year it will grow by $3.5 trillion. Do you think taxes are going to go down in your retirement? Let's look a little bit why this is such a big problem. And the traditional, like I said, what Wall Street and even the mom and pop shops in the strip malls that are given financial advice, it's max out your 401k. Now they have jumped on the Roth conversion bandwagon a little bit over the past 10 years because they had to, but that was fairly limited. But their way of thinking has put all of these retirement assets in these tax deferred accounts. Guess what's going to happen when Congress looks at that $35 trillion deficit debt we'll have in a few years, and they see this huge pool of $1 trillion in retirement assets that has never had money paid or taxes paid on it, and they control how much you have to take out of those pools and how much taxes you have to. So basically they say, okay, there's a big pool of money. You have to pull it out. You have to send 1/3 of it to us. Guess what they're going to do? And I realize they won't just come out and do that because they'd never get elected again. But you know, there's lots of ways they can sneak it in there if they increase the distribution ratios. You know, that's kind of a passive aggressive way of increasing your taxes. So let's show how this can affect your retirement. If you have $1 million in your 401k, let's say you're solo, you know, or it can be an IRA, at your brokerage house. And I realize this is not how taxes work, but let's say that you're in the 25% marginal tax bracket and that's the highest. So you're not going to pay any less than 25. And anything more you make is going to be taxed at 25%. So if you have $1 million and you decide you're going to go raise bees in Argentina for your retirement and you need all your money, you call your broker and you say, okay, you know, withhold taxes, but send me the rest. Is he going to mail you $1 million? No. And in reality, if you did this, it'd be more like 37% today. But just for illustration purposes, he's going to give you $750,000. So if you've got $1 million in a tax deferred account, you don't have $1 million. You have $750,000, which is not bad because you pulled that money out pre-tax, or you invested that money pre-tax, or you took a tax deduction. But let's say that you've got that same $1 million in your retirement account, and whatever Congress looks like, they decide that they have the weight to pass some tax increases 10 years from now. And if you go back, this is the crucial number, that U.S. federal debt to GDP ratio, and I won't go too much in the weeds on that one, but there are a lot of people that say, oh, a debt or deficit is not bad as long as you have adequate GDP growth. The debt is 128% of GDP right now. In 2000, it was 57%. In 1980, it was 34%. Taxes aren't going down, people. So Congress looks at this, they raise taxes, and they say, you know what, we can get away with marginal tax increase to 35%. Nobody's going to balk at a 10%. That's not a 10% increase in taxes. That is a 40% increase on the taxes that you're going to have to pay. 25 to 35 is a 40% increase. So get smart, make sure you've got options. Sorry. So let's say Congress, at 25%, your $1 million is worth $750,000. At 35%, because Congress has been spending like drunken sailors for years and years in committees and investigations and exploratory trips using private plane, that kind of thing. Is that what you're working for? So those guys, and you know who those guys are. So those guys can spend your money and do it all on the taxpayer dime. So let's say they raise taxes to 35%. Your money, your account is now worth $650,000. So you had $1 million, but really, if you wanted to spend it, it was $750,000. Congress got irresponsible and had to raise taxes. Now your account's really worth $650,000. Now, typically, if you're in this type of an investment and you have the potential to go from 750 to 650 with the stroke of a pen, you also have the ability to make quick money off of there. There's a risk reward trade-off. You're not getting there's no reward to this side of the equation. Congress raises taxes, you lose $100,000. Congress isn't going to do something that's going to increase your account by $100,000, not with a $28.5 trillion debt. So what do we want in our investments? We've already shown that just dumping everything into tax deferred accounts, one, what are you gonna do when the market crashes? What are you gonna do when the market crashes 3 years before you retire and we have another 2001 or another 2008? You want flexibility. And this is important partly because of the taxation. So if Congress changes the required minimum distribution laws and they up the marginal tax bracket, if you've got all of your funds in a 401k, an IRA, a 403b, some sort of tax deferred account, you don't have any flexibility, and they know it. You have to pay whatever tax rate, you have to pull out whatever they say. So, and that leads us next to the next one. We want tax freedom. So we want to have flexibility as our situation changes 3 years from now. Maybe we want to take our family on a vacation. Can you pull money out of your 401k if you're not 59.5 without penalty? No. Can you pull it out of your IRA without penalty? Not a traditional IRA. In a lot of cases, not a Roth. You need to have choices. So if we've got a pool of money here that we can access without generating a 1099, without causing taxation of our Social Security, we have flexibility because we have an asset that has tax freedom. So, but we also need solid returns. It's one thing to just protect everything and tuck it away and say, oh, I'm not getting any 1099s. well, you're not getting any growth. We're going to show you how you can get solid double-digit returns that are predictable and can provide tax-free income. So it's one thing to get double-digit returns, but then if you have to give a third of it all to the IRS, that kind of kills your returns. So we also want asset protection. So it's great if we have $1 million in an account, but if a guy falls off our roof and sues us, for $10 million, with some retirement accounts, there is asset protection, but it's not ironclad. And it's definitely the traditional way of thinking going into an ETF or a, God forbid, a target date fund in your IRA. Look at the fees on your target date fund. Look at the underperformance on your target date fund if that's how you're in. And the reason people do that is because the investment industry has made things so complicated that people, they kind of by default say, oh, this matches my situation. That's exactly what they want you to do. But we can show you how to protect yourself from the upcoming market crash in an asset that is basically invisible to creditors and lawsuits. What we're talking about is life insurance policies that are exempt from attachment in the state of Texas. If you're in a different state, we can look up what the rules are there. But this is a really nice feature of an investment portfolio. So how are we able to do this? We use what we call tier one arbitrage. And I want to make fun of myself a little bit here because this is a phrase that I came up with, or a term. And I didn't come up with tier one or arbitrage. But when we started using this tier one asset and taking advantage of the arbitrage opportunities, I came up with that. But there are all sorts of euphemisms in this industry. And some of them, kind of amuse me and some of them kind of annoy me. But one of my favorites is correction. And what a stock, they don't want to say crash, they don't want to say downturn, it's a correction. Basically, they're saying, you've got Ivy League legacy MBA Biff sitting on his yacht with his Waterford crystal full of, I don't know what in it, I don't know any fancy scotches. But sitting there with with the one big ice cube in the round one in his Waterford crystal, and he's got his shoes with the little pennies in them, or maybe tassels. I bet Biff has tassels up on the rail of his yacht, or his partner's yacht, because they had a good bonus year this year. But they look out and they say, "Ooh, the average retail investor's account went up 12% last year. They're looking pretty good. Let's correct that. Let's put that money into our hedge fund that plays the other side of the coin," whatever the case may be. I just think market correction, what they're doing is they feel like you have too much of their money and they correct that situation. But there are some similar strategies out there to what we're doing. And basically we're using a tier one asset like a cash value life insurance policy. And we're using arbitrage and leverage, but there are a lot of people out there doing similar plans. I think by far, and when I say I think, I have analyzed everyone out there that I've run across, and we blow them out of the water. Now, you may have found one that's better than what we've got. Show it to me. I would love to see it. There are a lot of plans out there that look great on paper that are using IUL, which is tied to an index, so you don't really know what the policy is going to make in the next year. And these can be great as long as the market kind of goes up steady, but you get a few down years in a row and you have to start adjusting it. But there are a lot of plans out there that won't come out and say what they are. They're like, oh, we've got this and that, bank on yourself, be your own banker, infinite banking, Kaizen, TFRA. And that's the other thing. They're like, oh, you didn't know about this. We found this little code, or there's a tax-free retirement account that you didn't know you qualified for. Or I saw one that they were calling it Tara or Terra. I hadn't thought about that. Which is tax advantage retirement account. They're talking about life insurance. You can set up, it really is the best tool for providing tax-free income in retirement, but the rates aren't great. So how, you know, they're great compared to any other safe money, but you know, what can we do to get a little bit better than that 5% that a whole life policy pays? Arbitrage. So let's talk just for a second about what is a tier one asset. Tier one is the safest level of assets. So if you've got a bank that is being audited or they're just doing their books and you look at their assets to see whether it's a safe bank, the auditors will want the majority of the assets to be what they call tier one assets. That's hard assets, land, gold, treasuries, but it's also life insurance policies. And banks own quite a bit of life insurance policies. If you look at the balance sheet of most large banks, there is a significant amount of bank-owned life insurance. And the reason that is because the strategy is the same as what bankers do. And I'll get into that in a second. So how are we able to get better than just the 5% that our money would earn in this policy? With safe leverage. And the key to safe leverage is the spread. So the spread, the arbitrage here is what can we borrow money at and what can that money earn? So in this scenario, our tier one asset, let's say we put $100,000 into the cash value of it, and it's going to earn 5%. But because this is such a safe, predictable asset, banks will loan against it without requiring additional collateral. And that's important. I've put together some leverage strategies in the past, typically using, you know, riskier investments as the collateral, but you know, not much, but not nearly as safe as what we're doing now. But banks would come and say, oh yeah, this looks great. And they get it all down on paper and they say, yeah, we're going to loan 10 to 1. We're going to loan, which is what caused the 2008 crash. That kind of leverage, that and the underlying asset was very flawed. Talking about the mortgage crash. But the banks will loan it without additional collateral. So we put together these leverage plans, and the banker, the guy who's going to make a bonus on the loan, would get all excited, and then run it by a committee, and they're like, yeah, you know, this looks great. And we see all these assurances, but you know, he's got a section of land that we wouldn't mind putting up his collateral to, or he's got a CD at another bank. We want to put, a lot of times they'll talk a big game until it comes to time for the rubber to hit the road and they want extra collateral. But with this asset, they don't require outside collateral, and we can get great rates. So right now we can get about 2.5%. We can get money at about 2.5%. What we do is essentially establish a line of credit against our initial deposit. But in this scenario, we can get money at 2.5%, in our initial $100,000 deposit is earning 5%, or it's going to earn $5,000. So our spread here is 2.5%. That's the key. That's where the magic lies. That's what we start the process with. So you're thinking 2.5%. My banker drives the fancy Tesla and flies in a jet to his house in Hawaii. You know, he's not getting, you know, he's not doing that with 2.5%. And you're right. They're going to do similar to what we do as far as safe leverage. But you also have to remember your banker's doing that with your money. You go and you put your money in a CD and they'll pay you 1%. You go and buy a car and they'll charge you 6%. That's a 5% spread for the bank. But you know, banks do have initial seed money, but that spread right there is all on your money. So that's how banks make money. So 2.5%, your banker's not going to get too excited about. But remember, our original investment, the $100,000, and it doesn't even have to be an investment. And we do this all the time with people that have existing balances in cash value life insurance. your Northwestern Mutual, your Mass Mutual, a lot of those, we don't even touch the policies. We just put them up as collateral, get them to work for you. Sometimes some of the policies are out of date, and it makes sense to put the client in a new policy, but it all works great. So our initial deposit, the $100,000 is earning 5% or $5,000. But then the bank loaned us another 100, we had a line of credit for $100,000. We put in there, it earns 5%. We have to pay them 2.5% interest. So we keep 2.5% or $2,500. So my $100,000 original investment earned $5,000. The bank's deposit earned netted $2,500. I get to keep the $7,500. So I put $100,000 in a very secure asset with lots of guarantees, and it just earned 7.5%. Not bad, but it's 7.5% tax-free. You can pick some periods where without a bunch of fees, the S&P 500 returned around 8%, but that's fully taxable. Granted, if you have it in a Roth or something, that's great. But 7.5% without stock market risk, with some liquidity and some flexibility, but tax-free, that's awesome. But because this is such a secure asset, the banks will do it again. The banks will do it again. This is actually, this one reminded me of we set up an investment department for a CPA firm, and we've done a bunch of work with CPAs over the year. And that's how I knew this was such a great strategy when I took it to my engineers. And if you've ever worked with engineers, they have a unique set of questions, and they want to see the watch taken apart and put back together again to make sure you did it correctly. And there's not a fly in the ointment. I realize I'm mixing metaphors there, but when my engineers started buying into this and moving significant assets, and my accountants started putting their own money, and their clients' money in there, I knew we had a great deal, and that it had been thoroughly vetted. So what happens if we do this? We make, for 4 years, we make a deposit, the bank makes 3. So think about that, if you could put $100,000 into a retirement asset over each year for the next 4 years, would that help your overall picture, especially if that asset could provide tax-free income down the road? Of course it would, but not everyone knows they're going to have an extra $100,000 of income 2 years from now, 3 years. You may have a CD now, but you don't know that you're going to have an extra 3 years from now. Well, some people do. But, so our original deposit, we moved $100,000. It's earning $5,000 a year. Our bank's $300,000 is earning $7,500. It really earned $15,000, but we paid the interest back, so it earns $7,500. So our original deposit, $100,000, earns $12,500. $5,000 from our money, $7,500 from the bank. That's a 12.5% return, tax-free. So let's look at it if we keep going. What happens if we do it for 10 years? Think about how that would help your retirement. If you could put $100,000 a year into a retirement vehicle for 10 years and access money, have liquidity, flexibility, and be able to pull money out tax-free, of course that would help, but not everybody knows that they're going to have an extra $100,000 in the year 2028. So let's use other people's money. Let's use the guy with the G4's money, the banker. I guess I gave him a Tesla, not a G4, and he does have a Tesla. He does have a G4. So look, what happens if we let the bank make 9 out of our 10 premium payments? Our original $100,000 earns $5,000, but the bank's $900,000. So we put in $100,000, or we moved $100,000 into it, or we had an existing policy and we put it up as collateral. Then the next year, the bank gave us 100, 100, 100, 100. And we ended up with $900,000 in there. That really earns $45,000, but after we pay the interest, we're going to net $22,500. So our original investment of $100,000 earns $5,000, and we get to keep the $22,500 that the bank's $900,000 earned. That's $27,500 a year at that point that our $100,000 investment is earning. No stock market risk, and it's tax-free. It's not magic, it's math. If you think you can poke holes in this, let's set up a call, because that's the kind of thing we love, is getting into the weeds and seeing how these structures, how great they work in different scenarios. So let's look at a particular, this is an actual case study we did for a client. And this is, I'll say typical, but we've done this on both 25-year-olds and 72-year-olds. Not this particular strategy, but we have used this method, and it's very flexible. So this is a 50-year-old. He just became an empty nester, which I'm not sure how you do that by 50, but he's got a retirement account. He's got a lot of things set up, but he wanted, he's worried about his emergency fund. And he had $200,000 sitting in a CD earning 0.65% taxable. I told him, first of all, if you don't move it, call your banker and say, give me 1.13, or, that's ridiculous. But the other thing, he's got this money sitting there and it's not really earning that much. And he's just kind of rolling over the interest, but he's getting a 1099 every year. So $200,000 at 0.65, he's making about $100 a month. If you have a $200,000 asset, you feel like $100 a month is that money working for you, taxable. So he's netting $70 a month. So what we did is we moved that CD and we got it working for him. We put it into motion, and using the power of safe leverage, we will be able to generate $4.8 million in tax-free income. We ran his illustration to 85. So for 35 years, he is going to receive $4.8 million. And at that point, if he passes away at 85, his heirs will get $4.6 million, not his congressman, not his rep, not his senator, not his president, his kids, his church, his family, his charity that he was on the board of, and he worked for 10 years for. Don't send it to Washington. But so with the scenario, $200,000 becomes $9.4 million, and we haven't gone into some aggressive options spread strategy, or something that's going to get wiped out by the next market crash. We've already seen how many black swan events that can be out there with the pandemic and 9/11. You need some of your assets that are going to be tax-free and are going to be protected from the upcoming market crash. So let's look at the numbers on him real quick, just to back up what we showed. So this is the actual illustration we used, the case study for this particular client. He moved $200,000. And we didn't just move it and leave it, because it's such a great source of funds. So 7 years from now, he's going to want to buy a truck. And I realize you can't get a very good truck for $25,000, especially in the year 2028. But I guess he's counting on a good trade-in, and goes along. And about 10 years from now, it's his 30th anniversary. So down here, you can see where he's 61. He pulls out $75,000. He and his wife go to Europe for a month. They don't look at the right side of the menu on this trip, because he's got $75,000. He just wrote a check to himself for. And guess what? He's not going to get the unpleasant surprise of 6 months later having to send a third of that $75,000, which he spent in Europe, to Washington, D.C. No 1099s generated by this transaction. Then a couple of years later, it's time to retire. He starts pulling out $95,000 a year. Remember, he only put $200,000 in to begin. Pulls out $95,000 tax-free. So he's looking at a situation. He's got his IRA, his 401k. He's like, oh, if I pull 95,000 out of these, my Social Security is going to be taxed through the roof. Oh, if I pull my $95,000 out of here and the tax bracket's 45%, you know, it doesn't work. That you need flexibility. You need some tax freedom in your retirement plans. Goes along, but you know what? It's doing so well. We have to actually increase the amount of money he's pulling out of here. And you can see by the time he's 70, he's pulling out 174. So it's almost doubled in that 9 years, the amount of income he's able to pull from here, tax-free. 174,000 tax-free. Just picture that. You get a check for 50, you know, you write yourself a check for $15,000 a month, and there's no 1099 as a result of that. And by the time he's in his late 80s or mid 80s, which is how far we ran the illustration, he is pulling out $300,000 a year. And if you look, that total is $4.8 million in tax-free income over his lifetime, over that 35-year period. And over here, if you'll see that $4.6 million, if he passes at 85, his kids, grandkids, charities, church get $4.6 million, also tax-free. We can put together a case design with your numbers. You know, we design a policy with your specifics. We design income needs with your specifics. Put in there that you want to buy a third home 7 years from now, 10 years from now, 12 years from now. We do one of these where someone in their 20s, and granted, someone in their 20s probably can't put $200,000 in, but you can put $20,000 in once, and it makes such a great wedding gift if you can convince someone to do this. You will move the needle on their financial situation. So sorry about that. All right, so that's why he's so happy on that phone call, because we just showed him how 200,000 can become 9.4 million without stock market risk, without bond market risk, without real estate risk, without cryptocurrency risk. What are you going to do in your bond fund when interest rates go up? So once again, we just moved $200,000. He wasn't touching that money. He was letting it roll over and create taxes for him every year. He was getting short-term rates on his long-term money. We fixed that. He wasn't even really doing this to provide a big retirement asset. But now he has it. Now he's got flexibility. So it's not magic, it's math. Give us a call. Protect yourself now. Taxes are not going down. The markets are near all-time highs. Interest rates are near all-time lows. Taxes are near all-time lows. It is the time to do something. So let us put together a free case design. Give us a call. Send a message on Facebook. Send a note in the chat room here. We did get one question. Someone asked, what happens when interest rates rise? Because we are borrowing money. Well, they rise on both sides of the equation, because the policy, and the policies declare the dividend in advance. So if they come out and they say, uh-oh, my interest rate on my loan has gone up, but my interest rate on my policy hasn't gone up yet, don't do it that year. Wait till the interest rate on the policy comes up also. So if your 2.5 goes to 3, then your 5 is probably going to go to 5.5%. And we can make this strategy work with a lower spread. Typically, we'll run the illustrations at a 3.5% interest rate to borrow funds on our line of credit, and the math still looks great. So thank you very much for your time. If you have any questions, please reach out to us. But go ahead and send something today. Let us know. We'll set up like I said, a 15-minute, we can either do it via Zoom or FaceTime or just a phone call, whatever you prefer, and see if there's a way we can protect you from the upcoming market crash, how we can protect you from rapidly rising stock taxes. Go to usdebtclock.org. I'm not sure that's the address, but if you Google it, you'll pull it up. Taxes aren't going down. You've got all that money sitting there, and Congress is salivating, thinking, oh, if I can just get some of that and put it over here, I'm going to look like a hero. Thank you very much. Reach out to us. Have a great week.